Modern-day globalists would like us to believe they invented globalism. Yet all they are offering is an unprecedented plan for global power to be placed in the hands of a few powerful special interests. Globalism has existed ever since international trade started thousands of years ago. Whether it was during the Byzantine Empire or the more recent British Empire, it worked rather well when the goal was honest trade and the currency was gold. Today, however, world government is the goal. Its tools are fiat money and the international agencies that believe they can plan globally, just as many others over the centuries believed they could plan domestically, ignoring the fact that all efforts at socialism have failed. The day of reckoning for all this mischief is now at hand. The dollar is weakening in spite of all the arguments for its continued strength. Economic law is overruling political edicts. Just how long will the U.S. dollar and the U.S. taxpayers be able to bail out every failed third world economy and pay the bills for policing the world? The U.S. troops are now in 140 nations around the world. The answer is certainly not forever and probably not much longer, since the world economies are readjusting to the dislocations of the past 30 years of mismanagement and misallocation of capital, characteristic of fiat money. Fiat money has been around for a long time, off and on throughout history. But never has the world been so enthralled with the world economy being artificially structured with paper money and with a total rejection of the anchor that gold provided for thousands of years. Let there be no doubt we live in unprecedented times, and we're just beginning to reap what has been sown the past 30 years. Our government and the Federal Reserve officials have grossly underestimated the danger. Current concerns are expressed by worries about meeting the criteria for a government-declared recession and whether a weaker dollar would help. The first is merely academic, because if you are one of the many thousands who have been laid off, you're already in a recession. The second doesn't make a lot of sense unless one asks, compared to what? The dollar has been on a steady course of devaluation for 30 years against most major currencies and against gold. Its purchasing power in general has been steadily eroded. The fact that the dollar has been strong against third world currencies and against most major currencies for the past decade doesn't cancel out the fact that the Federal Reserve has systematically eroded the dollar's value by steadily expanding the money supply. Recent reports of a weakening dollar on international exchange markets have investment implications, but do not reflect a new policy designed to weaken the dollar. This is merely the market adjusting to 30 years of systematic monetary inflation. Regardless of whether the experts demand a weak dollar or a strong dollar, each inevitably demands lower interest rates, hoping to spur the economy and save the stock market from crashing. But one must remember that the only way the Federal Reserve can lower interest rates is to inflate the currency by increasing the money supply and by further debasing the currency. In the long term, the dollar is always weakened, and even if the economy is occasionally stimulated on a short-run basis. Economic growth can hide the ill effects of monetary inflation by holding some prices in check, but it can't prevent the overcapacity, the malinvestment which causes the economic downturn. Of course, the central bankers cling to the belief that they somehow can prevent the ugly corrections known as recessions. Economic growth, when artificially stimulated by money growth and low interest rates, generates the speculation we've seen in the stock, bond, and real estate markets, along with the accumulation of excessive debt. Once the need for rectifying the overcapacity is recognized by the market, these imbalances are destined to be wiped out. Prolonging the correction phase with the Fed's effort to reinflate by diligently working for a soft landing or even to prevent a recession only postpones the day the economy can return to sustained growth. This is a problem the United States had in the 1930s, and one that Japan has experienced for more than a decade with no end in sight. The next recession, from which I'm sure we're already suffering, will be even more pervasive worldwide than the one in the 1930s due to the artificial nature of modern globalism, with world paper money and international agencies deeply involved in the economy of every nation. We have witnessed the current and recent bailouts of Mexico, Argentina, Brazil, Turkey, and countries in the Far East. While resisting the market's tendency for correction, faith in government deficits and belief in paper money inflation will surely prolong the coming worldwide crisis. Alan Greenspan made a concerted effort to stave off the 1991-1992 recession with numerous reductions in the Fed funds rate to no avail. The recession hit, and most people believe it led to George Bush's defeat in the 1992 election. It wasn't that Greenspan didn't try, and in many ways the Bush people's criticism of Greenspan's effort is not justified. Greenspan, the politician, would have liked to please the elder Bush, but was unable to control events as he had wished. This time around, however, he's been much more aggressive with half-point cuts, along with 7 cuts in just the last 8 months for a total of 3 points cut in the Fed funds rate. But guess what? So far, it hasn't helped. Stocks continue to slide, and the economy is still in the doldrums. It is now safe to say that Greenspan is pushing on a string. In the year 2000, bank loans and commercial paper were growing at an annualized rate of 23%. In less than a year, in spite of this massive influx of new credit, these loans have crashed to a rate of minus 5%. Well, where's the money going? Some of it probably has helped to prop up the staggering stock market, but that can't last forever. Plenty went into consumption and to finance extravagant living. The special nature of the dollar as the reserve currency of the world has permitted the bubble to last longer and to be especially beneficial to American consumers. But in the meantime, understandable market and political forces have steadily eroded our industrial base while our service sector has thrived. Consumers enjoyed having even more funds to spend as the dollars left manufacturing. In a little over a year, 1 million industrial jobs were lost while saving rates sank to zero and capital investments plummeted. Foreigners continue to grab our dollars, permitting us to raise our standard of living, but unfortunately, it's built on endless printing of fiat money and self-limiting personal debt.